Hi, I'm Matt Winslow from MW Productivity. I coach shop owners across the US and Canada to help them implement change in their shop. No contract and a money-back guarantee. Welcome to part 1 of my exclusive AutoWare's Increasing Profits webinar. There are 3 key areas I help you focus on in your business. In order to make the money you want and enjoy the lifestyle you deserve, first, we have to clearly define how much money you want to make. We need to dial in the profit you need to pay all your bills at work, pay all your bills at home, enjoy the lifestyle you deserve, and put money aside for retirement so you can live your golden years without stress. Second, we need to work together to manage your cash flow carefully. Most small businesses fail due to low cash flow, not low profit. And third, here comes the hardest part, I help you execute your plan through your employees consistently. And when necessary, recruit, hire, onboard, train, and manage new employees as your team changes over the years. In this webinar, I want to focus on dialing in the profits you want. I meet shop owners everywhere with the same problem. They know they make money, but they don't know how much money they have and how much money they can spend. So how do we fix that together? By fixing one of the most important software packages you'll ever use, QuickBooks. A lot of shop owners tell me their books are screwed up. Yeah, their accountants eventually send them reports, but they're often months old and often don't match what their shop management systems report. Hey, accountants are great for filing taxes, but you must know your numbers better than any accountant. I mean, let's face it, if you don't know what you're spending, how are they supposed to know? Knowing your numbers is going to help you create consistent profits and reduce how much you have to pay in taxes each year. QuickBooks gives us 2 critical financial documents that I would look at on a regular basis. I like to look at mine every week. These documents are your balance sheet and your profit and loss statement, which is also known as your income statement. Your balance sheet shows you the true measure of your business's health. It shows you what you have and who you owe. I like to look at mine at least once a week. It tells me the cash I have on hand, the money that's coming in, the money I owe, and how soon I need to pay those bills. Your P&L, which is also called your income statement, shows you how much you sold, what your expenses are, and is required to fill out your tax return. QuickBooks uses a database to track all the money coming into your business and all the money going out of your business. This database is called your chart of accounts. Your chart of accounts must be set up exactly the way QuickBooks wants it to be, or total chaos breaks out when you're trying to figure out how much money you have and who you owe. You would think your accountant knows exactly how to set up your chart of accounts in QuickBooks. But, after looking at thousands of profit loss statements and balance sheets, I have to tell you from what I've seen, most accountants aren't actually experts at setting up your chart of accounts, at least in an optimized way for an auto repair or collision repair shop. As a matter of fact, my accountant that does my taxes said to me recently, he should learn how to use QuickBooks at some point. Accountants are good at filling out tax returns, but filing tax returns doesn't require them to really understand your QuickBooks. Since most shop owners have screwed up books, I like to help them fix their chart of accounts in QuickBooks pretty early in my coaching program. And I've spent a lot of time with the folks at QuickBooks to know exactly how your chart of accounts should be set up for an auto repair or collision repair shop. Some of the fields in your chart of accounts map to your balance sheet and others match to your P&L. Your balance sheet shows your bank accounts, which is your available cash, your assets, which are the things you own, your liabilities, which are the bills you have to pay, and your owner's equity, which is essentially what would be left over. On your balance sheet, there's one critical formula to remember. Assets equal liabilities plus owner's equity. When we're setting up your chart of accounts in QuickBooks, Each account must match to a specific type in the tax form section. You can name each account anything you like, but if it doesn't match one of the exact fields found in the tax form section, then all your reports will become a total mess. When I'm fixing QuickBooks for my clients, I start with their bank accounts first. Then I set up their accounts for other current assets, and then I add their fixed assets accounts. And then I add accounts for their current liabilities, which are due this year, and then I add their long-term liability accounts, which are due over multiple years. Finally, I add their equity accounts. By the way, when you put your own money into your business or you take money out for personal use, it shows up in your equity accounts. Your P&L, your income statement, shows how much work you sold, which is your income, how much you spent to buy your parts and labor, which is called your cost of goods sold, and how much your overhead expenses were. Finally, it shows your net income. Net income is the amount you'll pay taxes on. Now that I've finished creating accounts for the balance sheet, it's time to create the accounts for the profit and loss statement. Your income accounts are for sales, and this is where things tend to get really screwed up. The problem is QuickBooks doesn't really understand the sales and expenses terms you're used to. So I have to match the terms you understand to the terms QuickBooks understands. You sell parts, so I create an account called Part Sales, but I have to match it to the sales of product income in the tax form section. That way QuickBooks understands what this account is and how to map it to your tax return. You also sell labor, so I create an account called Labor Sales and map it to the service fee income in the tax form section. Usually I'll add a sublet sales account for most shops as well. Then I create accounts for the things you purchase that you also sold. These are your cost of goods sold accounts. If you didn't sell it, then it doesn't belong in cost of goods sold. I've seen some trainers try and put the cost of a service writer or service manager in cost of goods sold, and I get their logic. If you pay your service writer commission based on sales, then their pay is a variable expense, but it doesn't belong in cost of goods sold because you didn't sell their time. And it's really important your cost of goods sold accounts are correct and don't have any incorrect items there, for example, service writer, because this section directly maps to IRS Tax Form 1125A, cost of goods sold, which is required as part of your total tax return. Next, I create accounts for your operating expenses, which a lot of people call overhead. Operating expenses are expenses that only occur in this year's business activity. In other words, you're writing off this year's expenses against this year's income. One thing that confuses a lot of shop owners is writing off the purchase of equipment. You don't actually write off the purchase of equipment. You write off the use of that equipment for that particular year. If you're leasing equipment and you don't own it at the end, that's fairly simple. You simply just write off the lease payments as part of your operating expenses. But if you purchase equipment, you have to capitalize that expense through depreciation. Capitalization means this equipment has multi-year use, so you write off the portion of the cost of the equipment used for that particular tax year. And later you write off other portions of the cost of that equipment for future tax years. At this point, you're probably rolling your eyes over this whole QuickBooks information. I get it. You're probably hoping your accountant will just figure this all out. Unfortunately, that's pretty rare. If you don't understand your numbers, don't expect an accountant to understand them. Remember, it's your job to manage your sales and your expenses. It's your accountant's job to file your tax returns and help you pay the least amount of taxes possible. Now that we have the QuickBooks overview finished, it's time for the fun part. Dialing in the profits you want and creating your execution plan to pull it off. Let's start building your winning financial strategy. Every business has a financial model. This is the basic financial model for an auto repair shop. Labor is typically half your sales, and parts are typically the other half. In this example, if our labor rate was $50 an hour, in 1 hour's time, we'd sell $50 in labor and $50 in parts for a total sale of $100 in labor and parts. Your budgets to pay for the cost of your technicians and parts are as follows. Typically, you can afford 20% of your total sales to pay for labor, your techs, and 20% of your total sales to pay for your parts. That leaves you 60% left over as gross profit. Gross profit is the amount of money you have left over after you sell your labor and parts and pay the cost of your technicians and parts. An awful lot of trainers stop here and generally only focus on income and the cost of goods sold, the gross profit. And it's true, gross profit is the amount of money you made from the sale. But let's take a look at how your fixed costs, also known as operating expenses, impact how much money you not only made, but actually get to keep. Most shops pay their service advisors somewhere between 7 to 11% of total sales. And let's say in this example, you're not spending any money on marketing. Your operating expenses, also known as overhead, also include expenses called general and admin expenses. General expenses are rent, utilities, equipment depreciation, licenses, and so forth. And admin costs are anyone you pay in your business who isn't fixing cars or selling jobs. G&A expenses in a typical shop are about 20% of gross sales. One of the most critical numbers you must know in your business is your break-even point. Your break-even point is how much gross profit you have to produce just to pay the cost of your service advisor and your G&A expenses. In this example, we must produce $30 in gross profit just to cover the cost of our overhead and service advisor to be able to break even. Okay, let's review. In this example, we sold $50 in labor and $50 in parts for a total sale of $100. We paid our technician $20 for their time, our parts vendor $20 for their parts, so our total cost of goods sold was $40 and our gross profit was $60. Gross profit is how much money we made from the sale, but gross profit isn't how much money we get to keep from the sale. Why? Because we still need to pay our overhead. We paid our service advisor $10 for the job, and we covered our G&A expenses of $20, which is our break-even point for a total of $30. So, after paying our cost of goods sold and our overhead, we get to keep $30 for that hour of time before we pay income taxes. Another thing that shows up in overhead is marketing costs. Let's say you spend 7% of your total sales for marketing. So, if you made 60% gross profit, and you paid your break-even costs of 30% plus an additional 7% of your sales for marketing, then your net income per hour would be 23% of your sales, or in this case, $23. Most trainers tell you the net profit in your business should be around 23 to 30% of your total sales. 23% if you're investing 7% for marketing, and 30% of your sales if you're not. In this example, I used a $50 an hour labor rate just to make the math easy. If you're a collision shop, $50 to $70 an hour is probably close to what insurance companies want to pay you. But if you're an auto repair shop, my guess is your labor rate is a lot higher than $50 an hour. At my May training class in Lansing, Michigan, I asked the group what their average labor rate was. They told me to use $120 an hour as an example, so here's what that financial model would look like at $120 an hour. For an hour of time, we'd sell $120 in labor and $120 in parts. Our gross sales for that hour would be $240. For our cost of goods sold, we'd pay the tech $48 for that hour, our parts vendor $48 for the parts. So our total cost of goods would be $96, and our gross profit, which is how much money we made for that hour, would be $144, which is 120% of our labor rate of $120 an hour. By the way, we'll make $144 in gross profit, but that's not how much we get to keep because we still have to pay our overhead expenses. We'll pay the advisor $24 for the job, another $16.80 for marketing, and then $48 for general and admin costs. Our total break-even point per hour is $88.80 for overhead. So how much do we get to keep out of this hour's worth of labor and parts sales? about $55.20, which is about 23% net profit before we pay taxes. Notice in this example, we're showing a 60% profit margin on parts. So how do we get there? We need to buy our parts and sell them for a fair price, but not necessarily list price. So what's a fair price? A fair price is good for your customers, and it's also good for you, the shop owner. One of the things I do with shop owners is help reprogram their shop management system to mark up their parts fairly. Here's an example of the parts matrix screen on a Mitchell system. In this case, these markup amounts and profit margin amounts would be good for customers, but would be terrible for shop owners. And sadly, this is what I see when I take on a new client and they're not making money. There's a much better pricing strategy for marking up your parts. It's fair to your customers, and it's fair to you, the shop owner. Over the years, I've helped set up many shops' parts markup strategies to the numbers you see here. Many of these owners were very afraid their customers would be upset about it, but guess what they found out? Their customers were okay with it. Customers know you're going to charge them more for parts than they can buy them for wholesale. You have to source them. You have to inventory them. You have to handle returns. You have to deal with cores, and you have to warranty those parts and labor if anything goes wrong with the repair. Your customers know you're not just selling parts. You're selling a total service package that repairs their cars and keeps them running smoothly. They appreciate the peace of mind they get, knowing that if anything goes wrong, you'll take care of them and their vehicle. Incidentally, if you have a Mitchell system, make sure you click the button here that says Calculate the part sale based on cost. If you click the button that says List, Mitchell will display the list price only on your estimate screen, regardless of the markup you put in the parts matrix screen. The good news is, if you click Calculate the part sale amount based on cost, then you'll see a retail price based on your parts matrix screen plus the list price. So you can use either price based on your selling strategy for that particular customer. Now comes the really fun part, targeting your business for consistent success and profit. We're going to dial in the profit you want and create the execution strategy to pull it off. First, let's learn the difference between technician efficiency and shop productivity. Most shops only consider how many hours each technician produces each week. Hours they produce versus hours on the clock measures efficiency, how efficiently they use their time. But efficiency doesn't always mean productivity. Productivity is the total sales produced versus hours on the clock. Let's say your labor rate is $120 per hour and your technicians are 100% efficient. Then each technician would produce $120 in labor sales for each hour they're on your clock. If they worked 40 hours per week for 49 weeks, after you subtract vacations and holidays, then each tech would produce $235,200 in labor sales per year. And if you had 2 techs, then your average month would be $39,200 in labor sales for a total yearly sales of $470,400. That's $470,400 in labor revenue to pay your bills. Hey, how would you like to double your productivity without having to increase your technician's efficiency? Simple, sell more parts. A healthy shop doing proper vehicle inspections will usually have a 50-50 mix labor to parts. Your 2 technicians producing exactly the same amount of labor hours as before would produce $235,200 each in labor sales plus an additional $235,200 each in parts sales, for a total sales for your 2 techs of $940,800 in labor and part sales each year. Which would you rather do? Pay your bills with $470,400 in gross revenue, or pay your bills with $940,800 in gross revenue? Notice this shop is only doing $600,000 in total sales. So, fixing their productivity problems would put an additional $340,000 in revenue in their bank account without having to hire any more technicians or be open any more hours. Okay, now that we know how to measure productivity, let's dial in the profit you want and create your execution plan to pull it off. First, we need to go to your QuickBooks and figure out what your true break-even point is, which is your fixed costs. In this example, I'll use $120,000 per year. Our gross profit goal so far is to produce $120,000 after paying for labor and parts to cover our fixed costs of $120,000 so we can break even. I'm guessing breaking even isn't your final goal. Let's say you want to make $150,000 in profit to pay for your desired lifestyle. To save money on Social Security taxes, if you're an S-Corp, you'd probably take a salary of $50,000, which is subject to Social Security taxes, and take out $100,000 in distributions, which is not subject to Social Security taxes. So far, we need to produce $270,000 in gross profit to break even and make your $150,000 per year in profit. But shops require equipment, and equipment either breaks or becomes obsolete. So let's make an additional $25,000 to keep your shop's equipment and software up to date. So far, we need to make $295,000 in gross profit after paying for your technicians and parts in order to cover your overhead, pay you $150,000, and have $25,000 left over each year to cover your tooling costs. That $295,000 in gross profit will make a good living for you as long as you're working in your shop. But maybe we should put some money aside to pay for your retirement during your golden years. Maybe you make an additional $50,000 to max out the 401k for you and your wife each year. Now your gross profit goal is $345,000, and you still have to work at your shop full time. At some point, you may want to be able to work on your business and come and go as you please instead of working in your business running your front counter. So let's make an additional $80,000 to cover the admin costs to replace you and your spouse in the day-to-day operations of your business. Our new target gross profit goal is $425,000 after we pay for parts and labor costs. Now that we have our financial plan dialed in, we need to create an execution plan so our managers and technicians can reach our profit goals every week. I added the $425,000 in gross profit per year under the section Manager's Weekly Financial Plan. If we're open 49 weeks per year, after we subtract vacation days and holidays, our gross profit goal per week is $8,673.47. Let's say we have 2 technicians, each working 40 hours on the clock per week. That means we have 80 tech hours to sell per week. To produce $8,673.47 in gross profit per week over 80 hours, we need to average $108.42 in gross profit on the sale of parts and labor for each tech hour on the floor. So far, we have our weekly key performance indicators to keep our profit goals on track. In the auto repair business, you check how you're doing each week to make sure you're winning the game, but you actually play the game one job at a time. So let's take a look at what we need to focus on when we're pricing each job. Let's say we're selling 3 hours of the 80 total we have to sell this week. Our gross profit goal is $325.26 after paying your techs and your parts for those 3 hours. So how much do we need to charge our customer at a minimum for these 3 hours? If you're paying your technician $32 per hour, your total cost for 3 hours of their time is $115.20 in wages and payroll taxes. Let's say your cost of parts for this job is $147.50. Then the minimum you can sell this job for is $587.96. If you're using the parts matrix suggestion I mentioned earlier in this video, your price will most likely be higher than $587.96, and that's okay. Why? Because if your technicians didn't achieve 100% productivity last week, then you have to adjust your weekly financial plan this week to make up for it. Let's say last week your technicians were only 75% productive. Then this week your gross profit goal for each hour has to exceed $144.56 to make up for the profit you lost last week. In this case, the minimum you could sell this 3-hour job for this week would be $696.37. Does that mean you should make your customers pay more when your technicians aren't productive? No. But by creating detailed financial and execution plans and by keeping your eye on your critical KPIs each week, you'll be able to provide high-quality repair and service at an affordable price your customers and your bank account will love. In part 2 of this webinar, I share how you can make a lot more money and make your customers happy by adding more related parts to each job. I'm Matt Winslow from MW Productivity. Thanks for watching part 1 of my Increasing Profits webinar. I provide advanced training, coaching, and mentoring for shops in the US and Canada. My mission is to help you make more money, enjoy more free time, and make things run smoother in your business. With the right coaching, you can survive any economy, reduce your stress, and make your business fun again. Please reach out to me today to see how I can help you reach your goals and live your dreams. Call or send a text to 443-214-4169 or send me an email at matt@mwproductivity.com. I can't wait to hear from you.